Welcome back to the deep dive. You know that feeling, right? When you go to the doctor and you're just anxiously waiting for that diagnosis?
Yeah, or your car is at the mechanic and you're really hoping for that all-clear report.
Exactly. It's all about trust, isn't it? You're putting faith in an expert to give you the straight scoop on something vital.
Absolutely. And, well, in the world of business and finance, there's a very similar act of trust. It's about a company's financial health.
And for that crucial checkup, you turn to the auditor.
That's right. When an auditor comes in, their main job is to give an independent, objective opinion. Basically, do the company's financial statements truly present fairly what's going on, their position, their performance?
Right. And mostly everyone, investors, lenders, even the company itself, is hoping for what's called an unmodified or unqualified opinion.
That's the clean bill of health.
There you
It
go.
signals things look okay, the financials seem reliable.
But what happens when that picture isn't quite so rosy? Or maybe it's a bit fuzzy. Or even worse, flat out misleading.
Well, that's exactly where we're heading today.
Our mission on this deep dive is to really explore the critically important world of modified audit opinions. We're going to unpack what these special reports actually mean.
Yeah, why does an auditor issue one? And importantly, what signals do they send to anyone looking at a company's finances from seasoned investors to curious learners like you?
We're going to break down the two main reasons an auditor might issue one of these modified opinions. First, issues right there in the financial statements, errors maybe, or big departures from the rules.
Exactly. And second, issues with the audit process itself. Like the auditor just couldn't get all the evidence they needed to be sure.
Okay. And we'll tackle some dense sounding but really vital terms like materiality and pervasiveness.
And show you how understanding the differences there can really shine a light on a company's situation, maybe even change its whole reputation.
Okay, let's get into it. Let's unpack this. So, to really get why the modified opinions matter, we first need that baseline, right? The gold standard. The unmodified or unqualified opinion. What exactly does that mean for us, and why is it the one everyone wants?
Well, it's basically the auditor's highest level of assurance, kind of like their seal of approval.
Okay.
When they issue an unmodified opinion, they're formally saying the financial statements present fairly in all material respects, the company's financial position, results, cash flows, all that stuff.
And fairly means according to the rule.
Exactly. According to generally accepted accounting principles, or GAAP, here in the U.S., it means the financials seem reliable, trustworthy, consistent with the established rules. It gives the company's reported numbers credibility in the market.
And I guess that's what every stakeholder, investors, lenders, suppliers absolutely wants to see. Yeah. It feels like the basic requirement for trust.
Oh, absolutely. An unmodified opinion means confidence, transparency, a solid base for making decisions. But, and this is where we really start our dive in, an auditor isn't just a rubber stamp.
Right. They're independent.
They are independent experts. Their task is that objective opinion. So when they can't confidently give that all clear, that unmodified opinion, that's when they issue a modified opinion.
Okay.
Think of it like a spectrum of concern. Not just pass-fail, but more nuanced signals. Like a doctor giving a diagnosis, but with a really important but attached.
A spectrum of concern. I like that framing. So what are the different shades on this spectrum, the specific types of modified opinions we need to know?
There are three main types we'll explore today. Each signals a different level, a different kind of concern. First up, the qualified opinion.
Qualified. Yeah.
Yeah, imagine this like a mostly good but report. It suggests there's a specific issue, something significant, yeah, but it's not so widespread that it makes the whole financial statement unreliable.
So a problem, but it's contained, like localized.
Precisely. The rest seems okay, except for this one thing. Then you have the adverse opinion.
That sounds
It is. It's a much stronger, like, no, this is fundamentally wrong report. A huge red flag. It's saying the financials as a whole are misleading.
wow. Okay. And the third.
The third is the disclaimer of opinion. This is basically the I can't tell you report.
Can't tell you. Why not?
Because the auditor just couldn't form any opinion at all.
Yeah.
Usually because of really pervasive limitations on their work, they couldn't get the info they needed.
Okay, those sound like very different levels of alarm bells. Qualified, adverse, disclaimer. How does an auditor decide which one fits? It feels like there must be specific criteria.
There are. And this brings us to two absolutely crucial concepts. Understanding these is the key to decoding any modified opinion. Materiality and pervasiveness.
Materiality and pervasiveness. Got it. Let's break those down. Materiality first. What makes something material in an audit?
Okay, so an omission or a misstatement is material if it could reasonably be expected to influence the economic decisions of someone using those financial statements.
So it has to be big enough to matter.
Exactly. It's about significance. If a huge company is off by, say, a few $100s on some tiny expense, probably immaterial, won't change an investor's mind.
Right.
But if they misstate their revenue by millions, or they don't disclose a massive lawsuit that could bankrupt them, that's definitely material would affect decisions.
Okay, makes sense. Like a crack in a foundation versus a crack in a bathroom tile when buying a house.
Perfect analogy. The foundation crack is material. The tile, probably not. Now, the other concept which gets really interesting is pervasiveness.
Pervasiveness, how widespread the issue is.
Exactly. A misstatement or an issue is pervasive if it affects many different parts of the financial statements, or if it's fundamental to understanding the whole picture, or if it impacts a huge chunk of the business. It's about how widespread, how fundamental, how deep the problem runs.
So materiality is about the size or importance of one issue, while pervasiveness is about how much that issue spreads through the whole set of financials.
That's a great way to put it. Think about it. A material error might be messing up depreciation on one building. Significant? Maybe, but isolated.
Okay.
But a pervasive error. Maybe it's a flawed accounting system, spitting out wrong numbers across revenue, expenses, assets, liabilities, everywhere. Or maybe management made a decision that undermines the reliability of the entire reporting process.
Like the leaky faucet versus the flooded basement.
Exactly. One's annoying, the other affects everything.
So how do these two concepts, materiality and pervasiveness, connect directly to those three opinion types? Qualified, adverse, and disclaimer. This feels like the decision tree for the auditor.
It absolutely is. It's the crucial distinction. Okay, scenario one. An issue is material, but not pervasive.
Significant, but isolated.
Right. That typically leads to a qualified opinion. The auditor is saying, look, these financials are generally fair, except for this specific material issue we found. It's like a yellow light for that specific area.
Okay, qualified means material, but not pervasive. What if it is pervasive?
Now, if the issue is material and pervasive, so it's significant and it affects the financials broadly, fundamentally, then it depends on the type of issue.
Type of issue.
Yes. If the pervasive issue is a misstatement in the financial statements themselves, the numbers are just wrong. Or they violate GAAP across the board that leads straight to an adverse opinion.
Because the whole thing is fundamentally misleading.
Precisely. The auditor is declaring the entire set of financials unreliable. But what if the issue isn't a known misstatement, but rather the auditor couldn't get the evidence?
The scope limitation we mentioned earlier.
Exactly. If the issue is material and pervasive because the auditor was unable to obtain sufficient appropriate audit evidence, that scope limitation, then that leads to a disclaimer of opinion.
Because they just couldn't verify enough to say anything definitive about the overall picture.
Right. They couldn't get enough reliable information to form an overall opinion. So that distinction, misstatement versus lack of evidence and just material versus material and pervasive, that's the core logic driving the type of modified opinion.
Okay, so let's dig into the most severe one first, the adverse opinion. This happens when the statements themselves are wrong, and it's a big, pervasive problem. How serious is this, really?
It's the nuclear option of audit opinions, really.
Yeah.
The most severe type an auditor can issue. It's like the doctor saying, forget the checkup. This patient's health report is fundamentally inaccurate.
Wow.
An adverse opinion means the financial statements do not present fairly, in conformity with GAAP, because of significant widespread departures. It's a direct statement. This financial picture is fundamentally misleading. You cannot trust it.
And the fallout for a company getting an adverse opinion, it must be massive, right? Like a giant red siren going off in the market.
Oh, absolutely devastating. It's a huge flashing red light for investors, creditors, suppliers, anyone relying on those numbers. It screams, danger, unreliable. The consequences are severe.
Like what specifically?
Well, think about it. The stock price likely collapses as investors run for the exits. The company will find it incredibly difficult, maybe impossible, to raise capital. Banks won't lend, investors won't buy shares if the books are cooked.
Makes sense.
Their credibility is shot. It damages relationships with customers, suppliers, even employees. Then you've got regulatory scrutiny that the SEC will almost certainly investigate, leading to fines, sanctions, maybe even getting kicked off the stock exchange.
Oh.
And internally, it often signals deep problems needing urgent management changes, maybe starting with the CFO. In the worst case, it can trigger a crisis that pushes the company towards bankruptcy because they just can't get the funding they need. It signals a total breakdown of financial integrity.
Okay, that paints a very clear, very bleak picture. So let's look inside the report itself. For a public company, an issuer, how does the auditor structure this adverse opinion to make the message absolutely clear?
They structure it very precisely. First, the opinion section. This is front and center. It states directly something like, in our opinion, because of the effects of the matters discussed in the following paragraphs, the financial statements referred to above do not present fairly. In conformity with GAAP, it's blunt, no ambiguity.
Hits you right away. And then they have to explain why, right? What were these fundamental problems?
Exactly. Right after that opinion, you get one or more additional paragraphs. These are crucial. This is where the auditor lays out all the substantive reasons for the adverse conclusion. They detail the departures from GAAP.
And do they say how much it affected the numbers?
Yes, critically, they must disclose the principal effects of these issues on the company's financial position, results, cash flows, if it's practicable to figure that out. If they can't reasonably determine the exact numbers, the report has to say so. Sometimes they can point to a note in the financials if the company disclosed it there.
Can you give us a concrete example, like the sample report for X company in our source material? What kind of major error leads to this?
Sure. The X company example is perfect. The auditor flagged two huge issues. First, X company was carrying its property, plant, and equipment PP&E at appraisal values and depreciating based on those values.
Okay. Why is that wrong? Isn't appraisal value what it's worth?
But GAAP requires PP&E to be stated at cost, less accumulated depreciation based on that cost, not appraisal value.
Why is cost so important? Seems like a technicality, but you're saying it's a big deal?
It's fundamental. Cost is objective, verifiable. It's what you actually paid. Appraisal values, they're subjective. They can fluctuate wildly. They can even be manipulated. Using appraisal values makes the statements less reliable, harder to compare to other companies, harder to track over time. It undermines the whole objective basis of asset valuation.
Got it. It removes that solid ground effect. What was the second big issue for X company?
The second major problem was that the company wasn't providing for deferred in-pay taxes on certain timing differences between book income and tax income. Specifically, they used the installment method for taxes on some sales, but recognized the profit differently for their financial reports.
Deferred taxes. That one's always a bit tricky. Can you simplify why leaving them out is such a big GAAP violation?
Sure. Think of it this way. Companies often report things differently for accounting versus taxes. These differences, if temporary, create future tax obligations or benefits. GAAP says you have to record those future tax effects now on your balance sheet as deferred tax liabilities or assets.
So you're recognizing a future tax bill today.
Essentially, yes. If X company recognized profit now for accounting but pushes off paying taxes on it until later, they have a future tax liability. GAAP says put that liability on the books now. By omitting it, they understated their liabilities, made themselves look less indebted, and potentially overstated their profits. It hides a future obligation.
Okay, so these aren't minor slip-ups. They're fundamental issues messing with assets and liabilities. And the report actually showed the dollar impact, didn't it?
It did, and that's incredibly powerful for the reader. The additional paragraphs often have a disclosure of principal effects. For X company, it detailed how inventories were overstated because of weird depreciation, PP&E was way above cost, deferred taxes were missing.
Which affected profits, too.
Absolutely. It jacked up retained earnings artificially, created this weird appraisal surplus account. On the income statement, cost of goods sold was wrong, and net income was artificially increased because they weren't booking the proper tax expense.
So it's not just rules broken, it's here's exactly how much it warped their financial reality. That's vital info.
It is. It shows you, the learner, the direct financial hit from these GAAP departures. A clear warning. Now, other parts of the report. The basis for opinion section is mostly standard, outlining responsibilities. But there's one key omission in an adverse opinion for issuers.
What's that?
The critical audit matters section, or CAMS, is omitted.
Why leave out CAMs? Aren't those the really tricky audit areas?
They are. CAMs highlight areas needing complex auditor judgment. But if the entire financial statement is fundamentally misstated and misleading, which is what an adverse opinion means, then discussing specific tricky parts of the audit becomes kind of irrelevant, doesn't it?
Like why focus on one tricky calculation when the whole foundation is rotten?
Exactly. The entire statement is flawed. Highlighting specific challenging spots is pointless when the overall picture is declared unreliable. The absence of CAMs here is actually another signal of how bad things are.
So, bottom line for the listener, what does an adverse opinion really mean when you see one?
It's a blaring siren. It tells you, the learner, the financial picture is fundamentally misleading. It's not a reliable basis for any decision. It signals serious, pervasive accounting problems. If you see an adverse opinion, you should exercise extreme caution. Maybe just walk away. The numbers simply can't be trusted.
Okay, we've covered the adverse opinion, where the financials themselves are fundamentally wrong. But what if the problem isn't the numbers being wrong necessarily, but that the auditor just couldn't do their job fully, couldn't get the evidence?
That's exactly right. This brings us to situations caused by a scope limitation. The auditor was unable to obtain sufficient appropriate audit evidence.
It's not a known error, but an unknown, because they couldn't check.
Precisely. It's like the doctor saying, I can't give you a full diagnosis because the x-ray machine was broken, or the patient wouldn't let me run the blood tests. The auditor couldn't gather enough reliable information.
What kind of things cause these scope limitations? Why wouldn't an auditor be able to get the evidence they need?
Oh, it can be a range of things. Sometimes it's just time constraints. Maybe the auditor got hired too late in the year to observe the company counting its beginning inventory. How do you verify starting stock levels if you weren't there?
Right, you can't go back in time.
Exactly. Or it could be a direct inability to obtain specific evidence. Maybe they can't physically observe a large chunk of inventory stored somewhere remote. Or they can't get customers to confirm accounts receivable balances. Or, a big one, they can't get audited financials from a major subsidiary company.
So key pieces of the puzzle are just missing,
Uh,
unverifiable.
hmm Other times, it might be restrictions imposed by the client. Management might literally prevent the auditor from doing certain procedures, maybe denying access to records or people.
Whoa, that sounds suspicious.
It definitely raises red flags. Or the company's accounting records might just be inadequate, a total mess, incomplete, corrupted, making a proper audit impossible. Sometimes management refuses to give required written statements, or the client's lawyer won't respond about potential lawsuits. All roadblocks.
That's a lot of potential issues. Do these always lead to a modified opinion? Or does the reason for the limitation matter?
The reason matters, yes. Generally, limitations fall into two buckets: circumstances beyond the entity's control, or management-imposed limitations. If it's beyond their control, like that late hiring example where they missed the inventory count,
Hmm.
the auditor first tries to find alternative procedures. Can they verify the inventory number some other way? Through later tests, maybe?
So if they can find another way to get comfortable with the numbers, it might not be a scope limitation that affects the opinion.
Exactly. That's a key point. If alternative procedures work and they get the evidence they need, then no modified opinion is necessary for that issue. They found a workaround.
Okay.
But if those alternative procedures don't work or aren't possible, then it becomes a scope limitation, requiring a modified opinion, either qualified or a disclaimer.
Now, what about when management itself causes the limitation? That sounds way more serious.
It is much more serious. A management-imposed limitation suggests they might be trying to hide something. The auditor's first step is to ask management, formally, please remove this restriction.
And if they refuse?
Then the auditor has to escalate. They communicate directly with those charged with governance. The audit committee, the board, explain the situation and try to get it resolved.
And if that doesn't work, if management still blocks them?
If they still can't get the evidence, and the potential impact of what they can't see could be both material A&D pervasive, then the auditor faces a serious choice. Either issue a disclaimer of opinion, or in many cases, withdraw from the engagement altogether.
Withdraw.
Right.
Just quit the audit.
Yes, it's a drastic step, basically saying, we cannot perform a proper audit under these conditions because you are preventing us. It sends a very strong signal.
Are there times they can't withdraw, even if management is being obstructive?
Yeah, sometimes. If the audit is substantially complete already, or if they're legally required to issue some kind of report, like for a regulated entity. In those rare cases where withdrawal isn't feasible, they'd likely issue a disclaimer and might add an other matter paragraph explaining why they couldn't withdraw, detailing the management obstruction.
Okay, so let's talk about the opinions themselves when there's an audit issue. First, the qualified opinion. You said this is mostly good, but how does that work for a scope limitation?
A qualified opinion, due to a scope limitation, happens when the auditor couldn't get sufficient appropriate evidence, and the possible effects of whatever they couldn't check are material, but not pervasive.
So a significant blind spot, but it doesn't cloud the whole picture.
Exactly. The issue is important, but isolated enough that the rest of the financial statements are still considered fairly presented. They couldn't verify this one specific thing, but everything else seems okay.
How does that look in the report? Does it differ for, say, private versus public companies?
Yes, slight differences. For a non-issuer report, like for a private company, ABC company, the sample, the qualified opinion section will explicitly say something like, except for the possible effects of the matter described in the basis for qualified opinion section,
Hmm.
the financials present fairly.
Possible effects. Okay.
Then, the basis for qualified opinion section explains why they couldn't get the evidence. The ABC company example was about an investment in a foreign company, XYZ.
Right. They couldn't get info on XYZ.
Exactly. They couldn't verify the carrying amount of the investment or ABC's share of XYZ's income because they were denied access to XYZ's info management auditors. That's a classic material but not pervasive scope limit. It affects that investment, but not necessarily everything else on ABC's books.
And the key phrasing is, except for the possible effects.
Yes, that's crucial. You qualify for the potential impact on the financials, not the scope limitation itself. You're flagging the uncertainty it creates.
Got it. How about for an issue report, a public company?
Similar idea, slightly different structure. The main opinion on the financial statements section gets modified with qualifying language, like except for the effects of adjustments, if any, as might have been determined necessary had we been able to examine evidence regarding the foreign affiliate investment.
And then they explain.
Yes, right after the opinion, there's an additional paragraph. This spells out why the evidence was missing, unable to obtain audited statements for the foreign affiliate, or couldn't satisfy ourselves by other procedures. That paragraph clearly flags this specific limitation for the reader.
Okay, that covers qualified opinions from not getting enough evidence. But you also said a qualified opinion can come from a misstatement, right? If the numbers are wrong, but it's not pervasive.
Absolutely. That's the other path to a qualified opinion. It's issued when the financial statements contain a material misstatement, a known departure from GAAP, but that misstatement is not pervasive.
So a confirmed error, big enough to matter, but it's contained.
Precisely. Maybe they messed up inventory valuation for one specific product line, but the rest of inventory is fine. Or they recognize revenue wrong on one big contract, but their overall revenue recognition policy is sound. The error is material, but it doesn't taint everything.
And the report would clearly state that error.
Yes. The opinion section would say, except for the effects of the matter described in the basis for qualified opinion section. And that basis for qualified opinion section would describe the specific GAAP departure. It might say, the company incorrectly capitalized research costs amounting to $6, which GAAP requires to be expensed. Had these costs been expensed, net income would be lower by Wallers. It identifies the error and quantifies it if possible.
So very clear what the specific problem is. Okay, that brings us to the most severe opinion related to audit issues. The disclaimer of opinion that we can't tell you. When does it get that bad?
A disclaimer is issued when the auditor cannot get sufficient appropriate audit evidence, and the possible effects of undetected misstatements are both material and pervasive.
So the blind spots are huge, and they affect potentially everything.
Exactly. The problem is so widespread, so fundamental, impacting large portions of the financials, that the auditor simply cannot form an overall opinion. There are too many significant unknowns, like trying to assemble a jigsaw puzzle with half the pieces missing. You have no idea what the final picture is supposed to look like.
Makes sense. Are there other reasons for a disclaimer besides just pervasive scope limitations?
Yes, two other big ones. First, if the auditor is not independent of the client. Independence is the bedrock of auditing. If that's compromised, no opinion is possible. Full stop.
Okay.
Second, if the financial statements are unaudited, but an accountant is somehow associated with them.
What does associated mean here, and why a disclaimer for unaudited statements?
Associated means the accountant either let the client use their name in connection with the statements, or they actually prepared the statements, even if their name isn't explicitly attached. If you're associated with unaudited statements, you must issue a disclaimer because, well, you didn't audit them. You can't offer an opinion based on an audit that never happened.
Okay. What if the auditor isn't independent, but still has to issue a report for some reason?
If they're required by law or regulation to report, despite not being independent, they must issue a disclaimer and specifically state they lack independence. It's a crucial disclosure. If they give reasons, they have to list all the reasons for full transparency.
And for those unaudited statements you mentioned, what are the rules there?
Even with a disclaimer on unaudited financials, the accountant still has a basic responsibility to read them for any obvious errors or clear GAAP departures. And very importantly, each page of the financial statements must be clearly marked unaudited.
To avoid confusion.
Absolutely. Now, here's a really critical point, an ethical tightrope. What if those unaudited statements are actually false or misleading? Management refuses to fix them, and just modifying the disclaimer isn't enough to warn people.
What then?
The CPA should strongly consider withdrawing from the engagement. Continuing association, even with a disclaimer, could be misleading if the statements are known to be fraudulent. It's about protecting the public trust and their own professional integrity.
That's a heavy responsibility. Okay, so back to the disclaimer report itself. How does it look different for non-issuers versus issuers? What's the specific language?
For a non-issuer report, like ABC Company, the disclaimer of opinion section is very direct. The auditor does not express an opinion. It carefully notes they were engaged to audit, not have audited, and points to the significance of the issues preventing an opinion. Then, the basis for disclaimer of opinion section explains the pervasive reasons. The ABC example combined two big ones: not being able to observe inventory counts beginning or end, and major problems verifying accounts receivable because of a new system.
And the combination made it pervasive.
Yes, because inventory hits cost of sales, net income, assets. Receivables hit assets, revenue. The combination affected too many fundamental, interconnected parts of the financials. They couldn't determine the necessary adjustments. Crucially, this basis section omits references to auditor responsibilities or sufficiency of evidence because no opinion was formed.
And other sections changed too.
Yes, the auditor's responsibilities section is modified to say they were engaged but couldn't get evidence for an opinion, and any key audit matters section would be omitted.
Okay. And for issuer reports, public companies getting a disclaimer.
Similar core message, slightly different format. The disclaimer of opinion on the financial statement section states they were engaged to audit and do not express an opinion due to inability to get evidence. Then an additional paragraph follows immediately, providing all the substantive reasons.
Like, what kind of reasons for an issuer?
The X-company sample for a disclaimer might cite things like, the company did not count its physical inventory for 2 years, impacting huge inventory numbers, and evidence supporting the cost of property and equipment is no longer available.
Yeah.
And critically, the company's records do not permit the application of other auditing procedures.
So massive asset categories just couldn't be verified, and the records were too poor for workarounds? Sounds pervasive.
Definitely pervasive. It undermines core assets and related income statement accounts. Now, here's another key structural change in an issuer's disclaimer. The basis for disclaimer of opinion section is heavily edited.
Oh, so?
It removes the sentence about the auditor's responsibility to express an opinion based on the audit, ATADAD. It removes the entire second paragraph that usually talks about conducting the audit according to PCAOB standards.
Why remove that standard language?
Because they couldn't fully conduct the audit according to those standards due to the pervasive scope limitation. Removing that language is a powerful signal that a standard audit wasn't possible. And again, the critical audit matters section is omitted.
Wow. And what about that disclaimer for lack of independence for an issuer?
That one's super short and blunt.
Yeah.
It just says something like, we are not independent with respect to XYZ company. The accompanying financial statements were not audited by us, and accordingly, we do not express an opinion on them. Clear, direct, no mincing words.
Okay, that was a lot of detailed ground we covered, but it really paints a picture of how precise these reports are. So let's try to connect all these threads. How does it all fit together for us, the learners, trying to make sense of this?
Absolutely. If you step back, you can really see how those different opinion types, unmodified, qualified, adverse, disclaimer map directly back to those two key concepts, materiality and pervasiveness.
Right.
Whether the issue is a misstatement or a scope limitation, its materiality and pervasiveness dictate the opinion. The summary tables and the source material are great for visualizing this. They show how the report structure changes too. Those extra paragraphs, modified sections, the deliberate omission of CAMs, they're all calibrated signals.
And what about uncertainty? We touched on that. How does dealing with uncertain future events fit into this opinion framework?
Great question. Uncertainty is a constant challenge for auditors. Here's how it generally maps. If there's no material misstatement, and they have enough evidence regarding the uncertainty, like the company's accounting for it seems reasonable, you get an unmodified opinion. If there is a material misstatement related to the uncertainty, maybe the company's estimate is way off or they didn't disclose enough, That leads to a qualified or adverse opinion, depending on pervasiveness.
And if they can't get enough evidence about the uncertainty.
If there's insufficient evidence, a scope limitation related to the uncertainty, they just can't verify the potential outcome or its impact, that leads to a qualified or disclaimer, again, depending on how pervasive that lack of evidence is.
That sounds like a tough judgment call for the auditor, especially with uncertainty. How do they navigate that pressure?
It takes significant professional judgment. Auditors have to assess the likelihood and potential magnitude of uncertain events, evaluate management's estimates and disclosures, and determine if they can get enough evidence. There's often pressure for clean opinions, but their duty is to reflect the risks accurately. If they can't get comfortable, they have to modify the opinion. It's about balancing assurance with necessary warnings.
So pulling it all together for the listener, why should you care about these nuances? Why not just look for unmodified and call it a day?
Because understanding these modified opinions gives you so much more insight. It lets you read between the lines. A clean opinion is great, but knowing why an opinion might be qualified, adverse, or disclaimed gives you critical information about a company's potential weaknesses or risks. It's like having a financial X-ray vision.
So it leads to much sharper decision-making.
Absolutely. These reports are crucial signals. An adverse opinion is a massive warning sign the financials are unreliable. A disclaimer means you have no reliable basis for judgment at all. The numbers are basically unauditable. Even a qualified opinion points you to a specific area needing serious scrutiny.
It helps you ask better questions.
Exactly. It empowers you to dig deeper, assess risks more accurately, and make smarter choices, whether you're investing, lending, partnering, or even just sizing up the competition. You can spot red flags others might miss.
And it really highlights the importance of the auditors themselves, doesn't it, as independent watchdogs?
It really does. Their reports, even the modified ones, serve a vital public protection function. They bring transparency and accountability to financial reporting. They're not just bean counters. They provide an essential layer of independent scrutiny that helps keep markets fair and informed.
We've definitely taken a deep dive today into modified audit opinions. We've seen how they signal issues, differentiating between problems in the statements themselves, leading potentially to adverse opinions, and problems with the audit process, the scope limitations leading to qualified or disclaimer opinions.
And hopefully you, our listeners, now have a much clearer grasp of what the auditor is communicating through these different reports and how crucial materiality and pervasiveness are to understanding that message.
They really are the keys, aren't they? Materiality and pervasiveness unlock the meaning.
They truly are. They tell you if an issue is just a crack in the tile or a fundamental problem with the whole foundation.
So, here's a final thought to leave you with. In a world overflowing with information, where companies naturally want to present their best possible image, the carefully chosen words, and sometimes the omissions in an audit report, can be incredibly revealing. The next time you look at a financial statement, don't just check if the opinion is clean. Ask yourself, what did the auditor explicitly flag? What couldn't they get comfortable with? What might that qualification or that disclaimer or even that adverse opinion truly signify about the underlying health, the risks, and the transparency of that organization? Because sometimes the modifications, the exceptions, the things they couldn't say, that's where the most important story lies.